Hey guys, this is Kyle. Welcome back to the channel. Today I'll be talking about why I feel that the traditional investment vehicle of a 401k or traditional retirement plan is flawed and some of the methods in which you can put your assets to work better for you. Before we dive into all the reasons why a traditional 401k retirement plan is not the best way to invest towards retirement, we should first define what it is that people typically do to try to retire. So the standard advice in the US is to put your money into a 401k, typically through your company. You will put up a portion of your money, and the company will typically put up some form of match to that money. So, for example, you may be able to put up to 6% of your income, and the company might match up to 3% of your income in return. And basically, this money will grow in a account that is invested for you for the long run. You're not eligible to access that money until you're ready to retire. You have to be at least 59 and a half. But basically, you're saving up a lump sum of money so that when you do retire, you can pull a certain percentage of that retirement fund and use that to live on each year. The current retiring generation is the first generation to have to test out this idea of a 401k and putting money towards retirement themselves. Every generation previous had an option to put a pension forward with the company they were working at or have some form of fallback to retire. So in reality, this is the first generation that actually has to rely on their own abilities to invest in the market to be able to retire in a timely manner. There's a few reasons why this is a problem. The first reason is even with moderate and considered safe contributions to a retirement plan, you'll still be nowhere close to where you need to be to retire. So let's say someone starts contributing 10% of their income towards retirement starting in their 20s. They will still end up with significantly less money than they need. Typical advice is that you would pull 4% of your total nest egg at the end of retirement and use that towards your income each month in retirement. The only flaw to this is if, for example, the market crashes, then that 4% would be a reduced rate. So let's say you were able to retire with $1 million in your account and you were going to use that to fund your retirement lifestyle after the age of 65. Well, the only issue with that is, let's say that the market takes a downturn of 25%. Well, now you're looking to pull 4% of 750,000, which will be a significant difference in the income you'll be living on. So you need to either decide to pull more of that nest egg, risking your initial investment, or you'll have to live on a lower income for that year until the market corrects itself, which may take a few years. And so that's really the problem with having a lump sum of money up front. You run the risk of that lump sum taking a big hit and for you to have to adjust your lifestyle accordingly. That being said, even when people do retire, the amount that they retire with is typically less than they lived on while they were working. So we're sold this idea that you are to work from the age of, let's say, 21 or maybe sometimes 22, 23, 24, depending on if you go to college or not, things like that. You're supposed to work for 40 years towards building a better lifestyle. In theory, retiring with more money than you started with each month, right? Because that's kind of the dream. You get your ability to travel and do all these things that you wanted to do when you were working, but you can't. But the problem is people are going through their lives, they're looking to retire, and then they're realizing that they're going to retire with less income than they made when they were working. And I don't know about you, but that rubs me the wrong way, knowing that the whole point was to live a better life once you're retired, to be able to kick back, do the things you wanted to do while you were working, and just enjoy the freedom of that time. And to know that you have financial limitations because of that is really concerning, considering that's what's being pushed to us in society now. That's the plan. And it doesn't really make sense if you think about it. Ray Dalio, one of the most successful investors and hedge fund managers of all time, advised that the more asset classes we are invested in, the less risk that we have. So in other words, the more diversity we have in our portfolio, the less risk we have in any individual investment. The real problem is when you look at a 401k or a traditional retirement account, all your eggs are in one basket. So you may be invested in a couple different funds, or you might have bonds mixed in there and all that good stuff. But the reality is, 100% of your portfolio is in the market, and it's in the U.S. market. So not only are you not diversifying across asset classes like real estate, commodities, venture capital, other ways to kind of diversify, you're also only in one economic market. So your 401k is not covering typically international markets or growth markets. It's typically just the U.S. market, and it really limits your ability to be protected against risk, really, because you are dependent on one crash and one growth. And so that poses a problem for people who are getting close to retirement. In theory, they should be reducing the risk, but 100% of their nest egg is all in one place. One of the other vehicles that a lot of people are dependent on for their retirement is known as Social Security. So typically that's something that you contribute to during your working years, and then you reap the reward of it in the form of a monthly payment once you retire. The only issue with this is they are projecting that Social Security will run out as of the year 2035. So in other words, for in particular my generation or even the generation upcoming looking to retire, you're basically paying for the previous generation's retirement. And you're putting all that money in each paycheck. They're taking it out of your paycheck to cover the costs of the current retirement. So when it comes time for the bill to come for your retirement, you're likely never going to see that money. And a lot of people depend on that as a part of their retirement because it comes in the form of a monthly payment. However, it's unlikely that you'll ever see a dime. My last and potentially most dangerous reason that a 401k or traditional retirement is a bad idea is it makes people lazy with their money and their investments. People do not pay attention to the progress of their account. They're not paying attention to the fees that are associated with these accounts through, the funds that they're being put into, and also the fees that their financial advisors are taking to assist them in these investments, and they compound to be a ton of money over time. And the problem is a lot of people will just put their head down and grind it out for 40 years only to discover that they weren't staying on top of their investments, weren't paying attention to how those investments were growing, and then will get down into their 60s and realize they don't have enough to retire. And that's a huge problem that people aren't focusing on their money, because at the end of the day, you're working to be able to retire with a nice sum of money. And I think that this system really teaches people to put money on the back seat or their investments on the back seat when that should be a conversation that you're having, whether it be with a spouse or just for yourself to review each month. It's very important to stay on top of these things. And I think a 401k provides a layer of inconvenience that makes it harder for you to track those things. So now you may be thinking, okay, great. We've determined that a 401k is broken. There's no way you're going to be able to retire the way you want to with that type of a platform. So what are the alternatives? How am I supposed to change up my portfolio so that I can retire comfortably? And I do have a few answers for you. So to start off, it's projected that 90% of millionaires made their money through real estate. Now, I'm not saying you have to be some big shot, millionaire investor who's got all sorts of properties, but buying and holding real estate for the long run has been shown consistently to increase people's net worth, their cash flow, and just it's a more reliable asset. So not only can you make money when the property value increases, you can also make money by renting it out. So you may buy a duplex, for example. You may live in one half of the duplex and rent out the other half. Even if the rental income cancels out your cost of living, that gives you thousands of dollars a year to invest or use towards bills and basically increases your free-flowing capital to use elsewhere. In addition to that, real estate is a asset that cannot increase. There will always be a set amount of land, a set amount of real estate, and so by definition, the value of it has to increase. It's not like the US dollar where they can just print up a storm to help them get out of an economic situation. Real estate is by design a limited resource, and by definition that makes it valuable. Another option for you is to start a business or side hustle on this, on your free time after work, and to kind of develop a business that will allow you to make money passively in order to reinvest or to consistently produce income for you month after month. Now, most people work a 9-to-5 job and they're kind of dependent on that income alone, and that may seem okay. However, if you're able to take that money and build an asset that can pay you month over month and build up your net worth as well, it'll create an extra blanket for you to be protected in case anything happens to that income. Although I don't advise or recommend going into your 401k and investing through the market that way, I do recommend doing market research and determining some companies that you truly believe in and investing in the market that way. Wealthy individuals, they will look for companies that they feel have a high growth potential, and they will take a shot on those companies in a calculated decision. So other than trying to just replicate the market growth and putting their money in a 401k, they'll make strategic decisions on companies that they believe in and invest through the market that way. Another way to do that, if you're more comfortable or willing to take a little bit more risk, is to get into venture capital, which basically means that you look for investments or business opportunities that you believe in that are in the early startup phases. This gives you an opportunity to get into the company early, and you can see massive returns on that money. Of course, there is more risk involved in these types of investments. However, when you look at successful entrepreneurs, successful businessmen and women, these are the types of investments they make. You'll never see them making an investment into their 401ks. You'll never see them trying to mirror the market in a safe way with their retirement accounts with a 401k. It's just not the reality that we live in. And, that's kind of the narrative that we've been pushed for so long. We really need to take a look at what is being done by the people that are finding success in the markets. I appreciate your time in watching this video. If you got to the end, please drop a like, give me a comment letting me know what some of your questions are, and I will see you in the next video.